What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are talking about SPACs. SPAC is an acronym, SPAC, and wherever you're getting your financial information from, you've likely started to hear more and more about SPACs recently. SPAC stands for Special Purpose Acquisition Company. In short, it's a company that IPOs for the specific purpose of raising money just in order to purchase another company. Now, if that's enough for you, congrats. You can close the video out right now, but if you'd like to know a little bit more, such as what's so different about a SPAC than other traditional investment vehicles, than other companies that IPO, the difference between the companies that these SPACs purchase and a regular IPO of those companies, and some potential pitfalls you may be concerned about avoiding right now with SPACs, stick around. Let's dive in. Okay, so what's so different about a SPAC? We have to look at what a regular IPO is, what it, the process, how a company that regularly IPOs, what that looks like and what they do with their money. So you have a company A, John starts a shoe company, right? And so he's making money, selling shoes, reinvesting the profits to grow the factories, hire more workers, and he's growing his company. And he looks and he sees some opportunities and he says, hey, if we could, do this by expanding our marketing team, and we could get some stores opened up in some strategic locations, and he has his whole plan laid out, but he understands, hey, we're only worth, a couple $100 million, and we need a lot more cash in order to make these changes and investments in our own company than we have, and it would take us 10, 15 years just from our current revenue and our projected growth to be able to save up that much in order to reinvest. And so they're looking at, hey, what are some options that we have to get our hands on some cash? Just for simplicity's sake, let's say John is the only owner. He owns 100% of the company. What he would do in this case is likely sell part of his company to the public. He would make a portion of his company available to be purchased by regular people like you and me. This is called an IPO, which stands for Initial Public Offering. He's offering to the public a portion or a shares of his company for the first time. The initial time. That's why it's called an initial public offering, an IPO. So he takes his company public by selling part of his company to the public. Now, when you look at how the shares are priced, you have to take into account a couple of things. The investment banks that are working with these companies that are IPOing, they look at a few things. Number one, what is the company making? Number two, how much does the company spend? Number three, what are they planning on doing with the cash that they want to raise from the sale of their company? And yes, they take into account a ton more than that, but for our purposes today, really they're just looking at, hey, what are the growth possibilities for this company with the cash that they're making versus what they're doing right now, and what's a fair valuation on the company that we can try and sell this portion of the company at. Now, John's not going to want to give up the entire ownership of his company. He's going to want to maintain, let's say, 51% ownership. Let's say he's trying to get a valuation of $100 million. That means he would be selling $49 million worth of his shares. So let's say he's looking for a $100 million valuation and he's keeping a little over 50% of his company. Let's say that for a $100 million valuation, he's going to divide that up into 10 million shares at $10 per share. He'll keep half those shares himself, a little over 5 million, and then sell the other for almost 5 million onto the market. Now, the valuation from that point forward is completely dependent on what the market does with it. They can buy a bunch of shares and that will drive the price up, or they could not be willing to buy the shares at $10 and just let the price come down. Maybe the public altogether thinks, hey, this is probably only worth, $8 a share, $80 million. Now, at the time of that initial offering, where they initially sell all of the shares that are made available to the public, they get an inflow of cash. They get that massive cash inflow of, let's say, just if they hit it right on the head at $100 million at $10 a share, that would mean that they are getting $49 million. From that point forward, then the company, they would take that money and they would, let's say, build some more factories, hire some more workers, start engaging in the plan that they had in order to grow the company. And then the future prospects for anybody who bought a portion of that company, they're looking at that and saying, hey, you're doing some good stuff with the money that you just raised by selling a portion of your company. And those things that you're doing are going to, over time, grow the value of the company. And you're going to start issuing dividends maybe in the future, and all sorts of growth prospects going forward. And so I'm going to hold on to my shares. But from that point going forward, anytime shares change hands on the market, that's just secondary market trading. That's just people swapping ownership of that same piece of the pie. So none of that buying and selling goes to the actual company. If the shares go up or the shares go down and more buying and selling is happening between people on the open market of the shares that were made available to the public, none of that actually impacts the company. The only way that would impact the company is if owners of the company want to issue more shares onto the market. Insiders want to start selling some of their shares, or the company needs some extra cash, so they need to sell some of their large stake in the company, do like maybe a secondary offering to the public. So of course I'm overgeneralizing there, but that's basically an IPO. So how does that differ from a SPAC? Well, a SPAC isn't a shoe company. They're not a technology company. They're not a software company. They're not a food company. They don't have any business whatsoever. The only reason that they form the company and issue shares to the public and raise a bunch of money by selling shares of their company to the public is so they can take all that cash and just purchase a company with that money. They're looking to raise a ton of money in order to buy a large company. Now, due to the legal structure, this means that if you buy shares of a SPAC, have no idea what the company will be that you actually end up owning once they make the acquisition. They aren't able to say, hey, once we do this, we plan on buying this company or this company, because then there's a lot more regulation and time and expenses involved with doing that kind of a filing. So the nature of a SPAC means that you don't actually know what company they will end up buying. So by definition, this puts a SPAC in the camp of a speculation. It can't be an investment. It is speculative by nature. Which, if you have a portion of your portfolio that is dedicated to, speculative investments, to speculations that, they can make a lot of money, they can also lose money, that's fine. Just understand that it's not technically an investment, doesn't produce cash flow, at least at first. They might purchase a company that ends up being a really great investment down the road, but at the start, it's by definition a speculation. Now, normally these SPACs have 2 years, a 24-month window from the time that they IPO to the time they have to make their acquisition. And if they don't make an acquisition in that time, the SPAC is dissolved and they return the money to the shareholders, which is a kind of a nice feature. Hey, we're either going to buy a company within this amount of time, or the shares are just going to be, the company's going to be dissolved and the capital is going to be returned to the shareholders. So if you're familiar with private equity at all, leveraged buyouts, this is probably ringing some bells for you, because it's a very similar process. It's raise a ton of money in order to buy another company. So it's essentially that. It's just brought to the masses. It's for the retail investor. Now that brings up another question. Are they dangerous? Because anytime you bypass big money and go straight for the retail investor, it does spark some red flags. It does, bring up some cause for concern, because big money is smart money. And so if they're going straight to the retail investor for something, you have to wonder, why isn't the big money getting into this first? So, are SPACs dangerous? Well, it depends. It comes down entirely to the company that the SPAC decides to purchase with your money, because they could end up purchasing a company that ends up producing a lot of profits, a lot of revenue, a lot of income and cash flow for years and decades to come, or they could end up purchasing a company that ends up going bankrupt. You don't actually know what they're going to purchase, and you have no ability to do due diligence ahead of time to see if the company they're going to buy is something you'd want to buy. So then this raises the question, if they're going to just go buy a company, why would that company sell themselves to the SPAC instead of just doing an IPO themselves? Because the SPAC has to IPO. Normal companies, if they want to raise money and sell themselves, normally they IPO. So why would a company sell themselves to a SPAC instead of just IPOing themselves directly? Now, this question used to raise a lot of red flags for SPACs, and it's why over time they've gained in popularity, but they didn't start out this way. Because any company that would just sell themselves to a SPAC was usually looked down upon and said, hey, if you're not good enough to sell yourselves an IPO, on the open market, then, and you have to resort to selling yourself to a SPAC in order to raise money, you're probably not that great of a company. But recently, with the growth of SPACs, there have been larger and larger and more high-profile companies and investors and people and names involved in SPACs, and so it's been raising the interest by companies and making it less of a taboo for companies to sell to SPACs. It's also much easier for a company to sell directly to a SPAC because it's more streamlined, it's faster, it's cheaper, and they don't have to go through all the regulatory and time-consuming and expensive processes of IPOing, because the SPAC has already done that part for them. Now, here's the other red flag. IPOs themselves generally start increasing in frequency towards the end of cycles. Usually there's a correlation between years in which there are a lot of IPOs, especially IPOs of companies that are money losing, that have never made a profit, and recessions and market crashes. Usually there's a correlation between those two. And so when you start to notice, hey, there are a lot of SPACs involved, which is just basically a way for companies to IPO by selling themselves to a SPAC, which is a way for a company to IPO in an easier way. When you notice a big growth of that, that should be a cause for concern as well, because you notice, hey, well, this just means there's a lot more companies who are selling a portion of themselves to the public, and that is a marker of kind of the end of a cycle. Now, in general, all else being equal, I am a huge fan of lowering the bar for regular people to get into investments. I don't agree with the fact that we have all of these laws preventing people with less and less and less money from having access to some of the best investments that are out there. There are a lot of rules and laws and regulations in place, like pattern day trading rules and the accredited investor rules, that prevent people who have long time horizons and could be very smart, who could know what they're doing, know how to do their due diligence and research for themselves. Prevents people like that from being able to invest in some of these investments that might have a higher risk, but also have the potential for the best possible returns. Somebody with $2 or $3 million who's retired, who can't afford to lose more than 10% of his net worth because he doesn't have time to recover from it because he's old and he's retired. Somebody like that is legally able to invest in something that is reserved for accredited investors, because his net worth meets the criteria, even though he probably shouldn't be investing in something like that. Whereas somebody who's young and just getting started off in their career and has saved up an extra, $20,000 or $30,000, he's highly educated and he's got tons of time to make back his money if he ends up choosing a bad investment. He's not allowed to invest in something like that. So I'm a huge proponent of, in general, reducing the bar, getting rid of red tape and regulations that allow anybody to make educated decisions and choices for themselves, rather than having the law try and do that for people, because it always backfires and there's always unintended consequences. But the timing of this is suspect. Over the last couple of years, the number of SPACs that have been issued have grown, and they've been increasing every single year. And this year already, we have more SPACs started than we even had during the entire year of 2019. And so it seems like there's a big push to get access to retail money, which will be used to purchase companies, which, remember from what an IPO is, that money is used in order to let owners of businesses sell part of their business in order to get a big inflow of cash. And if these companies aren't getting this cash from big money, which again, big money tends to be smart money, and they have to bypass that and go to retail investors, that's a red flag, because it's always going to be easier and cheaper, and you're going to get a better deal on the big money side than having to go through retail. So in summary, it's not the structure of an investment that makes it a good or a bad investment, that makes it a speculation or makes it dangerous or makes it cash flow. It's not the structure, it's the fundamentals. It's the actual business. So I'm all for creative ways to allow people to invest in things. We need innovation, and we need to lower the bar and allow more people access to invest in more and better types of companies. But there's no way to do due diligence and understand exactly what you will own at the end of the process. It's a roll of the dice. And the timing of this is concerning, given the rapid growth of SPACs, and the period at which we are at within the cycle would indicate that this is a kind of a last-ditch effort to get a lot of money from retail, because big money is passing up on these deals. As always, if you enjoyed the video, hit that like and subscribe button. You guys are the best. Have a great day.